Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in.
Paul, we're back again with another update on how the real estate market is shaping up here in 2026. So right now it is June 3rd, so we are right in the middle of the year, and I'm curious what your read is on the market. What's the data you're seeing? What's anecdotal evidence that you're seeing? Like, how should we understand if the market is up, down, sideways? Where are we at?
Yeah, well, Brandon, first of all, from a selfish standpoint, we're really going to focus on self-storage and small bay industrial and sort of how they're performing as we hit the mid-year point in 2026. Maybe reference some of the other major sectors in commercial real estate as we go, but I'm really going to focus on those two because that's what we do every day. Sure. And it's what our investors care most about. Let's start with self-storage. The first thing, and I don't think I've done this or said this before when we did our sort of 26 outlook. So we tried to look forward into 26 at the end of 25, and now we're halfway through the year. So we'll sort of test and see how well our outlook stands up from 6 months ago. But a lot of the data, particularly on self-storage, no, not particularly, a lot of the data on self-storage is based on data received from the REITs. As everyone probably knows, self-storage is a fairly fragmented industry. Over 60% of all self-storage facilities are owned by either individuals or small private equity groups, and that data doesn't aggregate very well. But the 5 publicly traded REITs publish a 10Q, a 10K, and quarterly financials every quarter, and they're required by law to disclose a lot of data. And so a lot of the data that I have to work with is really institutional level data from publicly traded companies. And I say that just because I'll point out something in just a minute. But the REIT data is the basis for the sort of national statistics that we all quote and refer to. We're in an interesting place, and I said this in an update to our investors not long ago, and I think I said this as we looked forward into 2026. We went through a very difficult period operationally in late 21 through about 2024, overbuilding driven by the high occupancy rates during COVID and low cost of money, really impacted most major markets. And for 28 months in a row, we saw declining advertised street rates on a month-over-month basis. That oversupply has clearly been absorbed. However, and we are at the bottom of a cycle, and in some markets beyond the bottom of a cycle. But the reality is it's not a steep curve coming out. And some markets are going to bounce along the bottom for another 6 months as they still struggle to absorb the excess supply. I say struggle, that's a little bit strong. As they still just work through the excess supply that was created in certain markets. But I'll always remind everybody that I can promise you right now, I can give you statistics that show that San Antonio, Texas is overbuilt. And I can then point to one of our new facilities that we just built that's leasing that up at above average pace because San Antonio may be overbuilt, but the 5-mile radius around that project isn't overbuilt. And at the end of the day, that's really what matters. But on the whole, I think we're seeing, we saw revenue growth reported by the REITs in the first quarter of the year, and it was the best quarter in the last 4 years in terms of revenue growth. That was primarily driven by in-place rents, not by new tenants and not by advertised rates. There still continues to be downward pressure on advertised rates, but in-place rent growth is real at about 0.6% month over month. So that would equate to something a little over 7% on an annualized basis.
Meaning they're charging higher rates for current tenants as the year progresses.
Yeah.
Okay.
And I mentioned, I think we were talking earlier, I mentioned there are a couple of other dynamics that relate to that. Number one, the average stay for a tenant has lengthened pretty significantly. And the other thing that's happened is that the ability to raise rents particularly for the REIT players, that's been their strategy. They use low advertised rents and then rapidly increase rates over a fairly short period of time. But you've seen stays in self-storage facilities, get longer, which has helped those in-place rent growth because they're a good operator is going to have price increases. And I think that's had a positive effect overall on revenue growth. We've also seen the data tell us that the percentage of the United States population that's using self-storage has grown from a little over 11% to just a little bit over 13%. That's a 2% move, but as a percentage of the 11%, it's about a 20% increase. Not insignificant. Occupancy has stabilized. We saw the advertised rate competition really put some pressure on people. Were dropping prices to maintain occupancy. Occupancy's really stabilized across all the market. And there continues to be weakness in demand. The housing issues that we've talked about, until the housing market unlocks. Mobility is a key driver in self-storage. And housing sales, residential real estate sales, drive about 25 to maybe 30% of demand in self-storage. And there's still activity there, but it's at reduced rates from what it historically has been. And so until interest rates come down and people start buying homes or being willing to sell their homes, as part of the problem is people have got mortgages at 2.5%, and they're not willing, even if they want to move, unless they're moving because they've got to move for a job or they live at a place they just hate, and they've got to get out. They're not going to give up a 2.5% mortgage and trade it for a 6% mortgage. And so you've got buyers that are constrained on one side and sellers on the other, and it's just reduced all the overall activity. But interestingly enough, the Midwest and Northeast have the strongest performance data for self-storage right now. And they're traditionally, that wouldn't be the case. It would be the Sun Belt markets. But the Sun Belt markets were the ones that saw the most construction activity in that 2022 to 24 time period. And they're the ones still working through the oversupply. So pricing stability and rent growth is stronger in the Northeast and Midwest than it is in the Sun Belt markets. But I think that's a short-term phenomenon that won't hold long-term as these Sun Belt markets work through the excess inventory and sort of get back, because they're the part of the country that's really showing any growth. Advertised rates continue to see pressure. Remember, in the self-storage industry, there are really two components of rate. One is what are you advertising to get a new customer? And the other is what are you charging your in-place customers, what are your in-place rents? And there's a pretty big delta between what you can rent for the first month and what you're likely to be paying 6 or 8 months later if you stay in that facility. This is one of the places where the data is really interesting. The REIT showed advertised rates down 3.6% month over month between April and May of this year. The non-REITs, or the privately owned facilities, showed advertised rates down 1.9% month over month from April to May. And it's a place where the REIT data, advertised rates are one of the data points that we can see across the entire market, because we can scrape competitors' websites and see what their advertised rates are. Unlike in-place rent growth and some of the other data that we really have to get from the REITs because we just can't see it from other operators. But it's an interesting place where the performance, where privately owned facilities that are owned by people like us, outperform the REITs. We were able to hold our advertised rates a little bit better than they were, even though we were competing with the REIT facilities. Part of the reason there is convenience. We build single-story drive-up self-storage, and I don't care who you are, backing up to your unit and unloading the sofa is a lot easier than loading it onto a cart, jamming it onto an elevator, going up 3 floors, and dealing with all the headaches that come with that. And a lot of the REIT facilities are now the multi-story sort of Class A, brick construction, all climate control, facilities. And so I think that's maybe one of the places. But private operators have outperformed the REITs for the last 3 months in terms of advertised rate performance. The last factor in self-storage, and we're about right on point. We're about 10 minutes in, so I'll give us 10 minutes or so to talk about small bay. And to me, this is an important statistic. It's part of our thesis for Fund 2 and Fund 1, and that is development continues to decline. And because of that, and because there is growth in demand, it's just not as dramatic as it's been in the past. Sequential improvement in the fundamentals, in the operating fundamentals for self-storage should continue through the balance of 2026. Again, it's not going to be a dramatic, steep curve climb out of this bottom, but I think we're pretty confident that because development continues to decline, because these Sunbelt markets have shown their ability to absorb this excess supply, because of the inward migration and the growth that they have had historically and continue to have, we see the market really stabilizing. And interesting statistics. I've talked a lot about this on a lot of our podcasts. At the peak in late 2022, late 2023, new supply was in excess of 4% of current inventory on an annual basis. As of May, it was 2.2% of existing inventory. Expected to deliver about 52 million, almost 53 million square feet of self-storage during 2026. By 2028, 2029, that'll be it's projected to be 38 million square feet on an annualized basis, which will put new development or new deliveries at about 1.7% of current inventory. And so you've got a market where demand continues to grow, although modestly. Housing will unlock, it'll take a leap, but it's still growing modestly. You're seeing longer stays. You're seeing a higher percentage of the population use storage. And you've got demographic trends that are driving all that. So you've got a demand curve that looks steady and increasing, and you've got a supply line that's going the opposite direction, declining from a high of over 4, currently at 2.2, trending to about 1.7% of current inventory. And we continue to believe this is an absolute great time to invest in self-storage, whether you're developing like we do or buying an existing facility.
Gosh, okay. So things sound good. This is promising. Latter half of 2026 into 2027. Feeling okay?
Yeah, but we're not going to see a return to the heyday of 2019, 2020, in the next 6 months. I think the market's maturing. It will behave more like a mature market. I think I don't think you'll ever see new supply at north of 4% of current inventory again ever in our industry, because the industry is becoming more sophisticated, more institutionalized, and those types of players are more disciplined in terms of how they make investment decisions than the historical base for our industry, which has been sort of more, I don't want to say mom and pop, but less sophisticated, less data-driven, players.
Question for you. How real quick, when you're looking at the public REIT data and, reading 10Qs, 10Ks, what's your sentiment on how you think about your investment decisions based on that data? And what I mean is the way that you guys think about the properties, the localities that you're investing in, hyper-local markets, 3 to 5 mile radius, and then these public REITs have these. It seems like the data would almost be so coarse, it would hard to make sense of kind of, I don't know, generally how you guys would want to invest. I'm not sure I'm articulating that well, but is the sentiment like, it's helpful information, but it really doesn't impact kind of how we're thinking about it? Or I don't know, what's the relationship between that?
You just nailed it right there.
Okay.
It's very helpful contextual information. It sort of paints the picture on a broad national basis. And is good for identifying trends and directions. It's not really useful for making individual investment decisions.
There you go. Okay, that's what I was
and I mean, you've got another complicating factor, which is Extra Space would be the one that's probably gone the furthest in this direction. They have a property management division, and we're starting to see a lot of privately owned facilities get rebranded as Extra Space, and they're not owned by Extra Space. They're managed by Extra Space. I think it's, I don't know. As an operator, that's not a direction I would go, but obviously a lot of people must think it's a good idea. But that adds a whole different dynamic because it takes facilities that used to operate like a private operator and turns them into facilities that are driven. I mean, the big REITs, particularly in the operating environment, are driven by algorithms and data. I mean, they've gotten as sophisticated with pricing as the airlines are. It's really demand-driven pricing, and their pricing may change hour to hour depending on what kind of activity they're seeing. So,
wow, okay, that's helpful. I was curious. I mean, we've got tons of episodes. I recommend folks listening go check that out on hyperlocal markets, how you guys underwrite deals. We've got a lot of data or content on that. But I'm just curious, like in the context of this conversation, when you're reading those, how you kind of working through them and how seriously to take them.
Like I said, it's great at a contextual level and sort of for trends and directions. Not super useful in making individual investment decisions.
Okay, interesting. Okay, thanks for that. Okay, small bay industrial. What's going on there?
Small bay industrial is easy. That's an easy. You couldn't have gotten this outlook wrong in December if you tried, because the data is just so obvious. Small bay industrial was and continues to be one of the strongest, if not the strongest segment in all of commercial real estate.
Wow.
Occupancy on a nationwide basis is north of 97%, and there are markets that are literally at 100%.
Wow.
The broader industrial market is still recovering from an overdevelopment that occurred in 2021 through 2024, sort of like self-storage did. And so the general industrial category, big box logistics, is kind of how it's referred to. The facilities over 100,000 square feet, and particularly facilities at approaching 1 million plus square feet, are still sort of digging out, if you will, from the oversupply. But small bay is so supply constrained, and the demand continues to grow that we're seeing extraordinary rent growth. I mean, we write into our leases in small bay, which are typically 3 to 5 year leases, a 3 to 3.5% rate increase every year. And that's on top of the fact that these are triple net leases. So to the extent that property taxes or property insurance go up, those costs are also being passed through to the tenants, along with common area maintenance costs. So really supply constrained, increasing demand, which is driving rent increases almost across the board, and a really significant increase in institutional investor interest. And I say significant on a relative basis, because if you look at institutional dollars invested in the different segments of real estate, the general industrial category is one of the largest places. And it's because you've got single tenant facilities that tend to be national or international companies with AAA, institutional credit ratings. And that's a safe harbor for institutional investors. The assurance that the income stream is going to continue is very high. Small bay is sort of the inverse of that. It tends to be smaller tenants, often local or regional businesses. They're not national businesses, and they don't have, institutional grade credit. But because of the dynamics in small bay, the supply constraint and the ability to raise rents and the increasing demand for it, the institutional investors are really starting to wake up. And I'll maybe give you a conclusion at the end of this, that what I think will happen over the next 5 to 10 years. But let's talk about the supply constraint for a minute. Over 80% of the small bay inventory in the United States was built before 2000. And there's been very little new, I think 23 million square feet last year.
Wow.
Across the country of new supply. So there's been very little built since 2010. And the big industrial developers would prefer to develop a 1 million square foot data center or a 1 million square foot Amazon warehouse because it's more efficient for them. When we're building a small bay industrial park, it's usually 100 to 120,000 square feet in 5 or 6 20,000 square foot buildings. That's just an inefficient proposition for an industrial developer who's used to building these massive facilities. So they just haven't taking advantage of what has been a really good opportunity, which has been great for us, right? We've had this market sort of to ourselves. What we do see happening is the institutional investment interest is starting to tick up, and non-traditional industrial developers like us are starting to realize there's a real opportunity in small bay. And I think what will happen, and I say unfortunate, it's not unfortunate, it's inevitable. But I do think the market will shift over the next 5 to 10 years. I think we've got a good 5 to 8 year window here before the market really changes. But I think it will become more institutionalized like self-storage has. You know, self-storage really began that transition process in 2012, 11, 12, 13 in there, coming out of the Great Recession. It became a favored asset class with institutional investors, and more real estate developers started to take notice and create product. I think that same transition will happen with small bay over the next 5 to 10 years. And it'll still be a great market to be in, but I think the next 5 to 8 years are a unique opportunity in small bay, where you've got the institutional interest, so you're getting the value on the exit, and you've got buyers that give you the market liquidity enough to be able to reasonably sell a property fairly quickly. And yet the threat of oversupply won't have grown to a point where it destabilizes the market at some level.
This might be a total rabbit hole, but I'd be curious how you talked about like business formation being, a factor to think about in this, and how entrepreneurship and people starting maybe these local or regional businesses might play into that over the next 5 to 8 years. Like I have people telling me they're sick of their office jobs and AI and all this kind of stuff, and so they just want to go start a trade, start an HVAC company or a lawn mowing business or something like that.
Well, but even the e-commerce side of the equation, and we've got tons of tenants that are selling coffee on the internet, and they've got a 3,000 square foot bay in one of our facilities with 1,000 square feet of office in the front and 2,000 square feet of warehouse in the back, and they're shipping out of the back. UPS truck drives up 3 times a day and picks up packages that are going out, and they're processing orders and doing all that in the front. So, it's so here are the factors that drive a successful small bay project. Number one, it's got to be a market with growth, and business formation is part of that growth. Needs to be a market with limited supply and pipeline growth, and that's almost the case in every market. You want a market with vacancy under 5%, and I can't find a market in the country that has vacancy over 5%. Yeah. And then the other thing is you want development costs below replacement cost. And that's often driven at some level by land cost. You can't go build a small bay facility and make them, well, you can, but the more expensive markets from a land standpoint are tougher to make the numbers work. But if you take those characteristics and you say, okay, where in the country do those exist? There are 4 markets. Number one is the Carolinas. Number 2 is secondary markets in Texas. In other words, not downtown Dallas-Fort Worth or downtown Austin, but the secondary markets around Dallas-Fort Worth, around, that in that I-35 corridor.
Yep.
Outside Austin and San Antonio. And then Tennessee and certain submarkets in Florida. I can tell you, I overlaid sort of the growth numbers, the supply and pipeline, vacancies, development cost, overlaid them, and those are the 4 markets that stand out. And 2 of them, the first 2, are where we're focused and where we're developing small bay. So,
that anecdotally, I can totally see that. I live about 6 blocks from I-35 in Fort Worth, and if you go about 30 minutes southwest of here, and then about an hour north of Dallas, and those 2 corners of DFW, just explosive growth, just amazing growth. Yeah, amazing.
Yeah, it's very interesting. But I think small bay industrial is probably the best opportunity I've seen in commercial real estate in the last 10 years.
Wow, hot take. Okay.
Yeah. I think it's okay. It's at a unique point in its evolution, and it's just hitting it. It's the unique combination. I said this a minute ago. The unique combination is there's now institutional interest sufficient to provide liquidity and it's yet still not seen the growth in the supply side of the equation that will start to distort the fundamentals. And there's, just like there was in self-storage, and this happened in self-storage beginning about 2010, 2011, up through 2019, 2020, when COVID kind of changed everything. There was a unique window of time, and if you look at our track record, the best deals we ever did, most of them fall into that time frame. Our average hold period pre-2011 was 8 years. Our average hold period from 2011 to 2022 was 3.3 years.
Gosh, yeah.
Our average IRR from inception in 1993 to 2011 was an 18% IRR. Our average internal rate of return on projects built between 2011 and 2021 was 33%.
God.
And I think we're in that second window in the small bay space, like in that 10-year stretch between 2011 2020, 9-10-year stretch that we saw in self-storage. I think we're getting ready to see that again in small bay.
This is fascinating. I want to emphasize that for our listeners, because you've been doing this a long time, 40 years. You've seen a lot of things come and go, a lot of trends, a lot of hype, a lot of whatever. Yeah. So for you to say that, seeing what you've seen, is strong, to say the least. Yeah. Interesting. Okay.
And it's the magic. It's pre where we are right now. We were able to sell properties, but there were a lot of institutional buyers, and the competition to buy properties wasn't there to drive cap rates downward. So although we were able to underwrite at a 10.5% yield on cost, 10.5% yield on cost, cap rates, which is a full 100 basis points above where we are on storage, cap rates were also 100 basis points higher. So the development spread, the profit opportunity, was basically equivalent to self-storage. We're now seeing the institutional interest start to compress cap rates in the small bay space, which is widening the development spread, and therefore the opportunity to develop, stabilize, and sell and create significant value.
Growth Fund 2, Growth Fund 3, here we come.
Yeah. We're even thinking about, this is a really hot take because we've not decided at all, but there's every chance in the world that Fund 3 will flip the allocation of capital and focus 60 to 70% of the capital in Fund 3 on the small bay side and 30 to 40% on the storage side. We'll keep building storage because we know it works and we know how to do it, and it's such a great asset class to be invested in. But I think we're in a unique window of time where the market's telling you this is the play whose time is really right now, and it's small bay.
Wow, interesting. Okay, so I won't hold you to that, but is same kind of market, so as what you would see, maybe over the next 5 to 8 years? Is it still going to be this Carolinas, Texas, and some other Sunbelt states like that?
I think there are opportunities in a lot of places. We'll focus in the Carolinas and Texas. Probably on the small bay side, a little less in Florida. But because Florida's a tough state to develop in. A lot of regulation, a lot of zoning stuff, a lot of, and it drives cost a little bit north of where, we'd like to be. So Carolina's very development friendly, Texas super development friendly. And those secondary markets supported by major metropolitan areas in the interstate corridors is it's just an opportunity. Like I said, it's as good as I've seen in the last 10 years. So.
Fascinating. Okay. Well, there's the takeaway for the show. Yeah. That's great.
So overall, the market outlook for the first half of 26 and looking forward to the second half of 26 is, I think self-storage continues to be a solid performer. And we're excited about how all the properties in Fund 1 and Fund 2 are performing. And then on the other side, I think small bay is sort of the timing is so right for small bay, not just in the balance of this year, but for the next 5 years.
Cool.
And
cool. Okay. I love it. Well, in a couple of months, I'm sure we'll do a 2027 market outlook, how things are shaping up then. But in the meantime, for those listening, to check out more and more of our data and content and resources, please go to aaaStorageInvestments.com/insights, and you'll see all this data that we're producing and the different episodes that we've done before, and Paul's wonderful wisdom, as always. Paul, thank you. We'll talk soon.
Been fun, buddy. Thanks.